I am David Stein of Money for the Rest of Us, and in this video I answer the question, should you invest in initial public offerings? Initial public offerings, IPOs for short. There have been a number of them this year, including Uber, Lyft, and Pinterest. Should you invest? Well, it's different than it used to be. Think Google or Facebook. When those companies went public, they generally were making money. They had profits. And they hadn't been private for that long. The traditional venture capital model, which started in the 1940s, is venture capitalists would raise money from institutions and high net worth individuals. Then they would identify, maybe a particular venture capital fund might identify 20 to 30 startups. They would seed capital, they would provide guidance, and after 3 or 4 years, they would build out the infrastructure of a profitable company that then they would then take public. And as an individual, you could participate and ride up that further growth in the company. That's different now. Now, the average company that goes public has been private for 10 to 12 years at a much higher valuation because there's something called unicorns. Unicorns are these private companies that have a value greater than $1 billion. That's a sizable company. But it's also a company that's not terribly profitable. Most don't have profits. So what has changed? One, the Jobs Act of 2012 allowed private companies to take on more shareholders, up to 2,000 instead of 500, before they had to disclose financial information. And so it was in their best interest to just keep bringing on more private shareholders, more capital without going public. The other thing that's changed is a term called blitzscaling. It's the idea is you raise a bunch of money and use it to essentially beat out all competition, a winner-take-all approach to business. In other words, build massive influence and scale without having any idea how to make money and lose billions and billions of dollars along the way. And then these companies that are losing billions are going public. And as individuals, we can buy Uber stock or Lyft stock, but we don't have the confidence that we might with a company that's already shown that they can generate profits and have a model that works to generate profits. It becomes really interesting. The Economist did a study, and they looked at some of these IPOs that were coming to the market, and they determined at the excessive valuations which they come public, that the 12 companies that they profiled needed to grow their sales or revenue by 49% annualized over the next decade to justify those expectations. As an investor in an IPO, maybe it's a great company, a great brand, but in order to make money in the stock, it has to grow faster than what the market has already priced in. In other words, the embedded growth assumption needs to be higher in order for the company to surprise to the upside, and the stock goes up in price. Now, when we look at these private companies, one of the things that they're doing in order to justify these high valuations is they don't use traditional accounting metrics like profits. They use alternative methods, like Uber has something called core platform contribution. And by that measure, they made $940 million last year. But if you look at their actually operating profit, they lost $3 billion. So when it comes to IPOs, we're not, as individuals, able to participate in the early stage or even medium stage of these companies. They're 10 to 12 years old, and they still haven't figured out how to make money. Yet, they're coming to market at very high valuations. It'll be interesting to see if they can beat expectations. But be wary in investing in initial public offerings. Hey, if you have any questions on this video, you can leave those in the comments, and please subscribe to my channel. Thanks.